So let's get right into it. In early 2026, the fintech world got absolutely rocked by a bombshell announcement. Capital One was buying Brex. Now, this wasn't just another merger. This was a massive multi-billion-dollar deal that sent shockwaves through the entire industry. It's got everyone rethinking what success even looks like in this new economic climate.
And that really brings us to the heart of the matter, right? On the one hand, you've got a staggering $5 billion exit. That's a huge number. But on the other hand, it's a sale at nearly a 60% discount from what Brex was worth at its peak. So which is it, a massive win or a sign of failure? Well, the real story, as you're about to see, is a whole lot more interesting than that.
To really get the drama here, you've got to rewind the clock a bit. Think back to 2022. The fintech gold rush was in full swing, money was cheap, and venture capital was flowing like crazy. At that peak, Brex hit a valuation of $12.3 billion. They were an absolute titan, one of the most valuable private fintech companies on the planet. Okay, now fast forward to the deal, and bam, $5.15 billion. That's a huge drop, no doubt about it. And yeah, on the surface, it just screams market correction. But here's the thing. That number doesn't tell the whole story. Not even close. There's a ton of smart strategy behind that price tag. So let's get into the nitty-gritty of the deal itself. And trust me, this isn't just another merger. People are calling it the biggest bank fintech deal in history. It's setting a whole new bar for the industry. So here's the breakdown. The terms are pretty straightforward. Capital One is the buyer, and they're paying over $5 billion in a 50-50 mix of cash and stock. But the really interesting part here is the structure. See, Brex isn't just getting swallowed up and disappearing into the Capital One machine. Nope. It's actually going to operate as its own semi-independent unit, with its co-founder Pedro Franceschi still calling the shots. And that, right there, is a huge detail. We'll circle back to that for sure. Okay, so to understand why they sold, you really have to understand the Brex story. It's this wild roller coaster ride that honestly tells the story of the entire fintech world over the last few years, from those dizzying highs to a much, much tougher reality check.
Brex started back in 2017 with a simple, brilliant idea. They saw that startups, the companies building the future, were getting completely ignored by big banks. So they fixed it. And man, did they ride that venture capital wave perfectly, hitting unicorn status and then that insane valuation in 2022. But then the music stopped, the market turned. But here's the thing, they didn't crumble. Nope, they got lean, they got focused, they got obsessed with profitability. And it worked. By 2025, they were back, growing like crazy again. And that meant they could walk into a negotiation not out of desperation, but from a position of real strength.
Now, this next part is super important to understanding the why behind this deal. It's all about their business model. Brex made most of its money from something called interchange fees, basically a tiny cut of every single dollar their customers spent. That sounds great when everyone's spending freely, right? But what happens when your main customers, startups, suddenly have to tighten their belts? Exactly. Brex's revenue took a direct hit. Now, you look at a competitor like Ramp, they went a different route. They focused more on SaaS, software subscriptions. That meant more stable, predictable money coming in every month. And in a shaky market, investors love predictable. So that brings us back to the big question. Brex is making a comeback, things are looking up, so why sell? Why now? Well, it turns out there wasn't just one reason. It was really a mix of 5 very smart, very strategic calculations. All right, let's run through them. First up, liquidity. Simple as that. You raise $1.5 billion, and eventually your investors want to see some real cash, not just numbers on a spreadsheet. Number 2, the world changed. The era of basically free money, that's over. Teaming up with a giant like Capital One, that's your stability right there. Third, and this is a big one, strategic acceleration. We'll get to that. Fourth, just being realistic about the valuation. The price they got was actually really, really good compared to similar public companies. And finally, number 5, the founder's vision. This wasn't about cashing out. It was about leveling up, using the power of a huge institution to make their vision a reality, just way faster. And that third point is perfectly summed up by this quote from the CEO himself, Pedro Franceschi. He basically said, look, this isn't us giving up. This is a time machine. It accelerates our mission by over a decade. Think about it. Instant access to Capital One's customers, their technology, their muscle. You just can't build that overnight. Okay, let's dig into that valuation pragmatism I mentioned. Yeah, $5 billion is a long way from 12 billion. I get it. But you have to look at it differently. You have to look at the price to sales ratio. Brex sold for 7.4 times its revenue. Now, look at these other big players in the public market. Affirm, Klarna. Brex actually got a better deal. So the board had a choice: lock in this really solid win right now or roll the dice on a risky pivot to AI. They took the smart money. So what does this all mean for everybody else in fintech? What's the big takeaway here? Well, to put it simply, the rulebook just got torn up and rewritten. Remember the old playbook? From just a few years ago? It was all about growth at all costs, blitz scaling, and this whole IPO or bust mentality. Well, that's out. The new playbook? It's about being profitable. It's about building a sustainable business. And, this is key, it's about seeing a big M&A deal like this not as selling out, but as a seriously smart, strategic move. It's the new win. So if you're a founder or an investor listening to this, what should you be taking away from all of it? Well, here are a few things. First, real money in the bank today is worth more than a huge valuation on paper tomorrow, period. Second, don't sleep on the big banks. They're not just building stuff in-house anymore. They're out there shopping for the best tech. And maybe most importantly, this shows that going it alone isn't always the fastest path to the top. Sometimes teaming up with a titan is the ultimate power move. And all of this leaves us with one final big question to chew on. For the longest time, the dream for every founder was to build a unicorn, a billion-dollar company. But maybe, just maybe, the goalposts have moved. In today's world, is the real prize not just getting big, but making the smart exit? The kind of exit that actually makes your mission happen faster and puts real money in everyone's pockets? That's the big debate happening right now, and this deal just threw a whole lot of fuel on the fire.